Here is a figure that should stop every currency trader dead in their tracks this Thursday morning. The US dollar index has surged to its highest level in 6 weeks, driven by overnight moves that are reshaping the entire G10 currency landscape before London has even fully opened for business. If you trade GBP, Euro, JPY, or any major pair, what unfolds in today's session could define the direction of your positions for the next fortnight. We are looking at a perfect storm: Federal Reserve hawkishness reinforced by last week's stronger-than-expected U.S. jobs data, a European central bank that cut rates at its July meeting, and a Bank of Japan still moving at a glacial pace toward policy normalization. Today on this channel I am breaking down every major pair, the data events you cannot miss this afternoon, and the single most important release hitting markets tomorrow morning. As of the London Open on Thursday, July 16, 2026, sterling is trading under pressure against the US dollar, with pound sterling to US dollar hovering around the 1.2690 level after failing to hold above 1.2750 during the Asian session. The pound has been caught in a tug-of-war all week. Softer UK retail sales published on Tuesday have rattled confidence in the domestic recovery, while the Bank of England's refusal to pre-commit to rate cuts has prevented a deeper sell-off. Euro to US dollar is similarly muted, trading just below the 1.0890 mark as European investors digest the ECB's July rate reduction. The standout mover in overnight trading has been US dollar to Japanese yen, which pushed through the 158.50 level, a 6-week high, as the yen continues to suffer from the widening policy gap between the Bank of Japan and a dollar supported by elevated US Treasury yields. Gold, which often moves inversely to the dollar, slipped to around $2,340 per ounce in early London trade. The catalyst behind this week's dollar rally traces back to minutes from the Federal Reserve's June 2026 meeting, released last Wednesday, which revealed that multiple policymakers on the FOMC remain firmly opposed to rate cuts until U.S. core PCE inflation returns sustainably to the 2% target. That hawkish tone was reinforced on Thursday when U.S. initial jobless claims came in at 211,000, well below the 230,000 forecast, signaling that the American labor market remains unexpectedly robust. At the same time, the European Central Bank cut its deposit rate by 25 basis points at its July 10 meeting, widening the interest rate differential between the Fed and the ECB to its most pronounced level since early 2025. For the pound specifically, a downward revision to UK Q1 2026 GDP growth, from an initial reading of 0.5% to a confirmed 0.3%, has added to the narrative of a UK economy losing momentum, raising speculation that the Bank of England may ultimately be forced to cut rates sooner than its current guidance implies. Sterling deserves its own dedicated section today because the data risk for the pound over the next 24 hours is exceptionally high. Pound sterling to US dollar has failed twice this week to sustain a move above the 1.2750 resistance zone, and technical analysts are now watching the 1.2650 level as a key support floor. A clean break below that could open the door to 1.2580. On the pound sterling to euro cross, sterling is holding up somewhat better, trading above 1.1830, because the ECB rate cut has placed parallel downward pressure on the euro. The critical event for the pound arrives tomorrow, Friday, July 17, when the UK Office for National Statistics publishes June 2026 Consumer Price Index data at 7 o'clock UK time. Market consensus is centered on a year-on-year reading of around 2.1%, a slight increase from May's 1.9% figure. An upside surprise, say, a print of 2.3% or above, would likely cause pound sterling to US dollar to rally sharply, as it would reinforce the case for the Bank of England to hold rates steady well into the autumn. The US dollar is the gravitational center around which today's entire Forex market is orbiting. The DXY dollar index is trading around 105.2, its highest reading since late May, and the fundamental driver is straightforward: higher for longer US interest rates make dollar-denominated assets more attractive to global capital. US 10-year Treasury yields are hovering around 4.55%, a level that continues to draw international flows into dollar assets and away from lower-yielding alternatives. Euro to US dollar has broken below its 50-day moving average this week, a technically significant development, and bears are now targeting the 1.0820 support area seen in early spring. US dollar to Canadian dollar is also worth watching at 13:30 UK time today, when Statistics Canada releases June inflation figures. If Canadian CPI undershoots expectations, US dollar to Canadian dollar could push above 1.3750, adding further momentum to broad dollar strength. The Australian dollar, meanwhile, is trading near 0.6420 against the greenback, weighed down by falling commodity prices and China growth concerns. The Japanese yen is perhaps the single most discussed currency in global Forex circles right now, and for good reason. US dollar to Japanese yen above 158 is a level that has historically prompted verbal warnings, and occasionally actual intervention, from Japan's Ministry of Finance. This morning, senior Japanese officials repeated standard language about monitoring excessive or disorderly currency moves, but no intervention has been confirmed. The yen's fundamental weakness is a policy story. The Bank of Japan's deposit rate sits at just 0.25% following its incremental hike earlier this year, compared to the Fed funds rate above 5%. That differential makes yen carry trades highly attractive and keeps selling pressure on the currency. Elsewhere, the offshore Chinese yuan is trading around 7.29 per dollar today, broadly stable after the People's Bank of China set its daily fixing within expected ranges. China's currency management has been a relative source of stability in an otherwise turbulent Asian FX session this week. In practical terms, today's market conditions carry real consequences for a wide range of participants. Retail Forex traders are navigating an environment where the risk of sharp intraday reversals is elevated, particularly around the 13:30 Canadian CPI release and any scheduled Fed speaker appearances this afternoon. For UK businesses with dollar-denominated supply chains, importers of electronics, raw materials, or energy, the pound slide from above 1.29 in May to today's 1.2690 represents a cost increase of roughly 1.5 to 2% in sterling terms on every dollar transaction. That may sound modest, but on large volumes it is material, and with UK consumer confidence still fragile, many businesses are absorbing those additional costs rather than passing them on. Currency hedging desks in the City of London have reported a notable uptick in forward contract activity from UK SMEs this week, a clear sign that businesses are moving to lock in current rates ahead of tomorrow's CPI data, which could move sterling sharply in either direction. Looking beyond today's session, 3 events will shape currency markets over the coming fortnight. First and most immediately, tomorrow's UK CPI at 7 o'clock, a surprise reading will move sterling sharply and reset market expectations for Bank of England policy. Second, the Federal Reserve holds its July interest rate meeting in the final week of this month, and Chair Powell's press conference will be scrutinized word by word for any hint of a shift in the rate cut timeline. Current futures pricing implies just one Fed cut in the whole of 2026, likely in December. If Powell pushes back against even that, dollar strength could extend meaningfully. Third, Eurozone composite PMI data, due Tuesday, July 21st, will provide an early read on whether the ECB's rate cut is beginning to stimulate business activity. If it disappoints, euro to US dollar could retest the 1.0780 area. The overall bias across the G10 complex remains for dollar strength in the near term, but the risk of sharp reversals is real and concentrated around these data events. To bring today's full picture together, on Thursday, July 16, 2026, the Forex market is defined by US dollar strength rooted in Fed policy divergence and resilient US economic data, a pound trading defensively ahead of tomorrow's pivotal CPI release, a structurally weak Japanese yen with intervention risk creeping higher as US dollar to Japanese yen holds above 158, and a euro softened by the ECB's July rate cut. The most important number to watch today is the Canadian CPI at 13:30 UK time. The most important event of the week is tomorrow's UK inflation print at 7 o'clock. Whether you are a day trader, a long-term investor, or a UK business managing foreign currency exposure, the message from today's market is consistent. The catalysts for significant moves are close at hand, risk management is not optional, and staying informed is your single greatest edge. Come back tomorrow for our live GBP CPI reaction video. Subscribe now so you do not miss it. We are live every weekday morning before the London session opens.